2025 is over, and some asset classes had strong years and others maybe not as strong. And the same question pops up in January: what should I have invested in? And that question assumes the goal was to pick the winner. What I want to do is zoom out a bit, because that question only tells us something in hindsight. The year already happened, the returns are already known. What's more helpful, especially when you're managing money over decades, is understanding how your portfolio behaved in any given year or during the year. And is it still structured in a way that supports where you're trying to go? In other words, did my portfolio do what it was supposed to do? And is it still aligned with where I'm headed? So let's walk through what happened in 2025, how this tends to play out historically, and how we frame this conversation with clients. This visual is one of my favorites, and it's called an asset allocation quilt. And you may have guessed why, because it kind of looks similar to a quilt, or some would argue a periodic table. Do not get too overwhelmed by the colors, the text, the numbers, the percentages. We're going to go through it. So what this chart is really sharing with us is each column represents a year. So we have 2025, which was last year, of course, all the way back to 2011. And going down these columns or these years are individual boxes that represent what's called an asset class, and each colored box is a different asset class. And when I say asset class, what this means is different parts of the global market. We're classifying the asset or the company, because not all companies are the same. We cannot bundle in every company into one category. Depending on certain economic conditions or interest rate movements, certain asset classes behave differently. So it's important to categorize them. For example, US large cap is just United States large companies. Netflix, Facebook, Amazon. US mid cap would be middle-sized companies. International developed, commodities, small companies, real estate, fixed income, or what may be referred to as bonds. We even have cash in here. So these asset classes make up the market, not the entire market, but the majority of the market for most investors. And each box is showing how that asset class performed in that year. And it's ranked from best return to lowest return. And one thing you might notice perhaps is how often the order changes. Last year's winner becomes next year's loser in 2021 to 2022, 2022 to 2023. Sometimes last year's winner becomes next year's winner, 2023 to 2024. Sometimes cash is the winner, 2018. Let's look at 2020. 2020 was, of course, when COVID hit, and it was a big checkmark year. So the market dipped way down in March and torqued back up in the back half. Rates also were cut. And so 2020, real estate had a tough year. But in 2021, if you remember, when people were refinancing and mortgages were at record level rates, real estate was on fire. And over longer periods, that rotation continues and becomes much more great. Markets respond to changing conditions. We just looked at one, right, in COVID in 2022, which was when inflation fear started to take headlines. Not only did we have equities down, we also had fixed income took a beating, which is, again, that interest rate relationship. So when things change, the asset class might perform differently and rotate. Now, some investors try to anticipate this. They try to anticipate what next year's winner will be. They try to position heavily in whatever they believe will lead next. Sometimes that works in a given year, but over time, doing that consistently becomes very difficult. So going back to our question, what should I have invested in 2025, maybe a good answer might be to own a mix of all of these asset classes, to have all of this in your portfolio. This is the idea of a diversified portfolio. We are not taking a single bet on one asset class. We are going to own all of them or a mixture of all of them and really smooth out the experience. And by taking that approach, your expectations just change a little bit. You know you're not going to be at the top. You also know you're not going to be at the bottom. And that's what this white box right here represents. A diversified portfolio is just a combination of all these different asset classes besides the white box at a certain mix. So this white box right here is showing a 70-30 mix. Don't get too caught up on what that really means. It's just 70% is on growth mode and 30% is in this gray and green box, more stable. And the purpose of this structure isn't excitement. It's just purely reliability. And when you're looking at the color of the boxes, you'll notice the white box tends to really hang, the white box tends to really hang in the middle here, right? We're going to be hanging in the middle. In this column here, the average annual return over this 15-year period, large cap is leading the way, mid cap, small cap, and here's our diversified portfolio. So what this is telling us is that 70-30 portfolio mix is averaging 9.68% a year over a 15-year period. Let's stick this in our back pocket. This is helpful to know. And it makes sense. Because we're owning all of these, we're probably going to be somewhere near the middle. And when we're managing clients' portfolios, we're not a firm that is going to pitch or offer outperformance. No, we are going to focus much more on what we can control and let the investments support the plan. When we talk about alignment, we're not talking about beating benchmarks or trying to get the highest return in a given year. We're talking about whether the portfolio supports the financial plan. But what the hell does that even mean? Well, let me show you. We just looked at the asset quilt. Now what we're looking at is an actual portfolio and how it's behaving year after year. So this is showing investable assets over time. So here's our starting balance in year 2026. So in year 2026, their ages 61 and 61, $1.1 million total portfolio or beginning balance, no planned distribution. This is just RMDs, so don't worry about this. We're going to need to take out $96,000 from the portfolio in 2026. Here is the assumed return we're baking into the plan. This is around a 6.5% return. And they're in that 70-30 model diversified portfolio mix. So for this couple, here's our beginning balance. Here's what we need to take out of the portfolio. Here's our assumed 6.5% return, which is way more helpful to see in dollar format, and our ending balance. And when we're managing the portfolio in real life, now we have a benchmark to aim toward. And as you saw in the asset quilt, that 15-year average was about 9%. But we don't want to include 9% in the plan. We want to be conservative. We call it lifeboat drill, right? You are going to have much more confidence and conviction making decisions when we are being more conservative in the plan. So we would say their portfolio is aligned with where they're trying to go. We're trying to develop a winning strategy. Our investment approach is coming from a method, and although it's boring and not exciting, it works. On the flip side, if you want to try to get the highest return year in and year out, that can be an exciting game. For example, you go to the casino and you're at the roulette table. This might be a bad example, but you're at the roulette table and you have, 50 chips. You could put all 50 chips on one number, or you could spread out the chips. Obviously, if you put all 50 chips on one number, there's a much greater reward, but there's a much greater risk because the odds of that number hitting is very low, very bare bones, but it's helpful to know how an aligned portfolio works or really fits in behind the scenes. When you look at your portfolio with this perspective, or when your portfolio is structured this way, the entire investing experience changes. Markets will still move, headlines will still come and go. Every year is still going to look a bit different, but the difference is how you respond. When something big happens, an election, a rate change, a coronavirus risk, the instinct is to do something because it's a threat. Your brain is trying to get you to react, to sell, to move to cash, to protect what you have, hurry before you lose it, right? It can feel emotional. But when something big happens and we have a conversation that we just went through, well, then you can just remind yourself that your portfolio was built to weather storms. It wasn't designed to predict every shift, every downturn. That's almost impossible. It was designed to hold together through those periods of uncertainty while your plan continues to work in the background. And this perspective makes decisions, I won't say easier, but at least comes from a grounded place. It reduces the urge to react. It makes it more likely that you're going to be on track. And over time, I'm telling you, over time, this consistency, this boring consistency matters. And it matters more than getting any single call right. But if you're like me, we lack patience and we want to make money quick. But is that really the best way? And yeah, even if it's just one person listening right now, I'm grateful for you and I appreciate you. Thank you for listening. Go have a great rest of your week. Bye.